Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Craig Martin, CFP, with the Family Wealth Consulting Group. So today we're going to be talking about investing in difficult times. And so with that, I think I'll go ahead and get into some questions. Oh, before I do that, Craig Martin's written a book. It's called Craig Martin on Asset Class Investing. And there'll be some contact information for Craig at the end of the show if you'd like to get a copy. Okay.
Thank you, Mike. It's great to be on your show.
Okay, thanks for being here, Craig. So with that, let's start with our first question.
Okay.
All right. Well, we've seen a pretty difficult time. We've got a roller coaster been going on with the stock market. The Dow Jones Industrial Average was 13,058 at April 28th of 2008, went down to 6,547 on March 9th. And then yesterday, which was July 13th, it closed at 8,331.
Lots of volatility.
Yeah. So, as an investor, should I be sitting on the sidelines in cash and bonds and sort of keep out?
Yeah. Investors are quick to make the decision to go into cash when they don't feel good. And they don't feel good when the markets go down. So during normal market cycles, I brought a slide in. Maybe we can put that up for the investors viewers to see.
It's a cycle of market emotions, yeah.
That cycle of market emotion shows that when the markets go up, investors get excited, they become greedy, and they want to buy. But when markets go down, investors get fearful and panic, and they want to sell. Mm-hmm. That pattern repeats itself during every market cycle. Mm-hmm. So when markets go up, investors buy in near the top, and when markets go down, they buy closer to the bottom. The effort by every investor is to get out of the markets when they don't feel good, but they want to get back in when the markets look better.
Yeah.
The terms they use are stable, feels better, less volatile. But they don't know when the valley of the market is, so they miss it. And many times the market has recovered and is on its way back up, and the investors are still sitting in cash. If we could take a look at the second slide. That slide talks about how the fear and greed in the marketplace causes investors to get less than half the return of a simple buy and hold. Mm-hmm. So over that 20-year period, that slide shows how investors, if they had purchased the market and held it for 20 years, they would be able to get more than twice the returns of the average investor who, through fear and greed, are trying to time the market. So, do not move out of the market into cash. You just don't know when to get back into it.
Right. So when we get into this mode of fear and greed and so forth, in other words, we're responding or reacting to what's going on out there. What actually happens is a lot of people do exactly the wrong thing for the time that they make the action.
It's okay to have the emotions. We're all human.
Uh-huh.
It's just not okay to make investment decisions using those emotions.
Right.
Yeah.
Well, let's talk a little bit about the role that emotions play, when we're making these decisions, and whether we should disregard them and so forth.
Yeah, emotions are a powerful drive when investors make decisions. There was a Nobel Prize issued just 4 or 5 years ago to Professor Kahneman, who showed us convincingly that emotions are a powerful force when investors make investment decisions. If we could take a look at the next slide. This slide is just 2 years later than the previous slide, and what it demonstrates is that even when the markets went from 11.8% return in ending 2006, by the end of 2008, the buy and hold of the market would have returned 8.5. But the average investor is no longer earning 4.3%. They're now earning less than 2 1.9%.
Yeah.
That's a horrible indictment of the investing public, unable to pick the stocks and time the trades and beat a simple buy and hold of the marketplace.
Mm-hmm.
I need to know what the next slide is.
It's called Missing 10 Days.
Oh, yes. So if we could have a monitor on here, that'd sure help. So this slide demonstrates how investors are trying to time the market and be out of the market when it doesn't feel good and be back into the market when it does feel good.
Mm-hmm.
What it shows is that the average investor is going to get significantly less than a simple buy and hold of the marketplace. So the upper line demonstrates how well the investors do by a simple buy and hold, and the middle line is what investors get when they try and time the market.
Uh-huh. Okay. Well, here we go again then. The average investor, should the average person even be investing in the stock market?
Oh, yes, Mike. If we could bring up the next slide, what it shows is that the returns of the marketplace have over the last 80 years produced about 10% per year. So a dollar invested in the marketplace produces at 10% rate of return significantly greater than the bonds do at 5% rate of return. And the bottom number is inflation. So the bottom number shows that you would need $12 to have the same buying power that $1 has today. However, that during that time frame, if investors had simply purchased the marketplace and held on to it, they'd have made 10% return per year.
Mm-hmm.
Mm-hmm.
And then we've got a historical, I guess, and now we've had something about a comparison slide.
Yes, this comparison slide
I think that was comparing for the stock market return versus the bonds, and that's where.
Yeah.
Okay. So
sorry. So the comparison slide shows that if you took 1 year rolling averages from 1926 forward, added the newest month and subtracted the oldest month,
yes, that
in fact you'd have 961 rolling 12-month periods. Mm-hmm. And 648 of those, or 68% of the time, you would have beaten T-bills by holding stocks.
Yeah.
You're confident, you had 68% confidence every 10 years, every year, that you would beat T-bills by holding stocks.
Yeah.
If you take 3-year rolling averages, first 36 months, and add the newest month and subtract the oldest month, there are in fact 937 of those time periods, and 76% of the time stocks beat cash or T-bills. Mm-hmm. So if you take 5 and 10-year rolling averages, that level of confidence goes from 76% up through 86%. And between 10 and 20 years if you buy and hold stocks for between 10 and 20 years, mm-hmm. you have a 100% chance of beating, historically, you have a 100% chance of beating T-bills. Mm-hmm. So should investors be in stock? Yes, it's the only way we know that you can beat inflation after taxes and expenses, and you have confidence every 10 to 20 years that you will, in fact, beat T-bills during that time frame.
So one of the issues